Hello everyone, welcome to our channel, The Wealth Capital. We are new to this content creation market and want to give a quick introduction of the team. There are a couple of us managing this channel and we are all traders at one of the bulge bracket banks managing a substantial book for the firm. Each of us have over a decade of experience in the market and have successfully built a solid trading track record in our day job. We are also active investors in the markets on a personal basis, leveraging on our own expertise to make informed investment decisions to make money on our own. And just like you, we are very passionate about the markets and love discussing trade ideas across markets and asset classes. We are starting this channel to share information, discuss trade ideas, and make money together. We are very new to this and would really like to hear your feedback on what you would like us to cover. We aim to engage further with each and every one of you and build a sharing community. So let us get started on our first topic for our channel. Today, we're diving into some significant news that has been shaking up China's stock market. Just on January 6, the US Department of Defense added Tencent and CATL to the Chinese military companies list. This list is also known as the Section 1260H list. And following this announcement, we saw that Tencent stock fell by 7% and CATL by 3%, so quite a big negative reaction compared to the HSCI, which was down 1%, and CSI 300 up by 1%. So today, we are trying to understand what is this event all about and whether this is the time to buy the dip or wait and see if there are more pressure to the stock. There are a lot of misleading information out there, but I want to clarify the first and most important thing that investors should know. Investors should know that being on the Section 1260H list alone does not impose any restrictions on trading securities of these companies. The real impact comes only if these companies are added to the non-SDN Chinese Military Industrial Complex Companies list or short NSCMIC list, which is maintained by the OFAC. In other words, only if and when these two stocks, Tencent and CATL, are added to the NSCMIC list, then US investors will not be able to own their publicly traded securities, which includes both equities and bonds. And if this were to happen, it could lead to significant selling pressure. But just how significant is this? To put some number into context and allow you to have a better idea, we can look at how much public float for Tencent stock is out there. An estimated value of around $54 billion of active funds and $19 billion of passive funds own it. And for CATL stock, this can potentially be $5 billion and $1 billion respectively. This sounds like crazy numbers, but these are public figures which you can just pull out from public filing. You must be wondering why we want to separate the active and passive ownership of the stock itself. This is the part where a lot of investors do not know unless you are in the trade yourself. The difference between active and passive fund selling is the discretionary power of the fund manager, and this is directly related to the speed and timeline of liquidating all of this out of the funds. Active fund managers can time the sale and have greater discretionary power to do it before the deadline. Whereas for passive funds, which is basically like an ETF, will have lesser discretionary power around the timeline and will almost certainly have to sell when the security drop out of their respective index, which is more immediate. So how does discretionary power affect anything? In simple terms, lesser discretionary means lesser power. And when it comes to the sale of the stock, it will become forced dumping of the stock, which could lead to great pressure on the stock within a short time frame. This is what can potentially happen once the stocks are added to the NSCMIC list. So can you imagine the size of the volume that has to be dumped into the street within a certain time frame when that happens? If we look at similar cases in the past where Chinese stocks were added to the Communist Chinese Military Company list, some of these companies saw an initial correction of about 8% in the first 2 months, but eventually recovered, often due to the strong southbound buying. but that was back in 2021, where the GDP forecast of the Chinese economy is much higher than currently. In other words, the outlook of the Chinese economy was much more positive back then, which have spurred some buying into the rebound, but certainly it is much bleaker right now. Let's take a look at the price action in the last few days. You will see the dip when the announcement happened. Shortly after the next day on the 7th, what is interesting is that according to HKEX filing, Tencent bought back almost 4 million shares at a price range from 376 Hong Kong dollar to 392 Hong Kong dollar. So the price jumped back up to 392.80 Hong Kong dollar at the highest point on the 7th. But unfortunately, this support could not hold and it quickly got sold down, which you can see from this chart. From this exercise, two things stood out for me. Number one, the stock buyback is insufficient to support the stock given the huge market cap of Tencent despite the positive signaling from the company. And number two, the southbound buying has been much weaker than expected, and largely because investors are still cautious given the disappointing policies coming out from China so far. What is actually worth noticing is that while many other YouTubers have reported on this news, none of them mentioned a crucial piece of information that was released on the following day. On January the 8th, the Office of the United States Trade Representative also released the update of its 2024 review of notorious markets for counterfeiting and piracy. This list highlights online and physical markets that reportedly engage in or facilitate substantial trademark counterfeiting and copyright piracy. WeChat, which we are all familiar with, was previously on the list but now has since been removed on the latest list published on January the 8th. This although sounds like a more positive headline, but I think both lists are interdependent on each other. I think the headline is at best more neutral in relation to the case of them being added to the NSCMIC list. Now, for the most important part of the video, our recommendations for those who are watching or listening. We think for investors, it is extremely tricky to get involved here. The lack of clarity on whether the two names will eventually be added to the sanction list is further clouded amidst the escalating US-China tensions. It took Xiaomi 4 months to be taken off the list back in 2021, and if we were to take that for reference, it will be an ongoing battle for Tencent and CATL in the coming months, and the uncertainty will definitely wane off buying. We know that southbound buying is unable to support any pressure, so we question, where is the additional buyer here? We prefer to wait for a better clarity and get involved in other sectors and stocks given the binary outcome of the situation. We think that potentially in the medium to longer term, there will be a better entry point for these stocks. That's all for today's update. We hope you like this video from us. We are very grateful if you can like, share, and subscribe our channel. We want to bring you analysis on what's hot in the market, so please feel free to comment and give us idea on what you'd like us to deep dive into. Thank you for watching, and we will see you in our next video.